Hello, I'm Lanny Cohen with Capital Commodity Services, and in today's video we're going to discuss wheat hedging strategies with futures and options. Before we get started, I'd like to address the risk. There are risks involved in trading futures, and only risk capital should be utilized. So if you're contemplating trading futures, please pay particular attention to the disclaimer that's at the bottom of every page of our website. Thank you. So our website, ccstrade.com, we're going to talk about wheat strategies. So for reference, let's go to quotes and charts, futures historical charts, and we've got historical charts for all the markets. So, but for today, let's look at wheat. Okay, so you click on the link and the current chart comes up. But for an example purposes, let's just look at last year, December of 2016 wheat. Let's see what we could have done. Okay, so there's a couple ways you can hedge with wheat. You can forward contract with your elevator, which is the same as selling futures contract. I'm not a big fan of this for a couple reasons. Particularly if your crop's not made yet, you could forward contract and not be able to deliver. Number two, it takes away all upside potential, so opportunity cost is lost. And number three, you could be subject to margin calls. Okay. All those reasons hold true for forward contracting with the exception of margin calls. Okay, but you do lose all that upside potential. And I remember when wheat went $3 higher one year. So, but anyway, what are your options? You could sell the futures contracts. I told you why I don't like those. You could forward contract. I told you why I didn't like those. You could buy puts. Okay. If you buy puts, keep in mind a put option is the right to sell, but it's a right that you can walk away from, and the most you can lose is the price you pay for that put. Now, puts are expensive if you buy them at the money, and but for me, it's the only way to go, and I have a strategy. It's called the scale-in strategy, where I wait for a rally, and then I start buying the puts. Okay, so I scale in every 10 cents, 10 to 20 cents, and keep buying more puts all the way up. So if we keep going, I can walk away from them. Otherwise, I'll be buying a new put every 10 to 20 cents above the market, depending on the client and their individual needs. And the goal is to actually, your real goal with me is to lose money. If you lose money on the options you buy, then that means the cash price is significantly higher, and it's a win-win for you. Okay, but in reality, what typically happens is the price comes down into the September-October time frame, and those options, those put options you buy, are worth significantly more. In this case, the highest put you would have bought would have been when the price was almost $5.50, and we dropped down to $3.90. That's a big move. That's a big move, and we're just trying to help your bottom line is the goal here. So if you'd like more information, I'll be more than glad to talk to you about it. In the meantime, I've compiled a list of my top 10 trading rules that if you've been trading for 20, 30 years, or if you're just getting started, these rules will help you. So just click the link below and give us your email address, and we'll send them to you free of charge, no obligation. So we also have a lot to offer. I write on a blog every day. We've got historical charts like I just showed you, every chart, every commodity, every year, going back to 1955 in some cases. We have seasonal charts that show seasonal tendencies for all the major commodities. Spread charts spread any commodity against another, or intercommodities. July corn versus December corn, gold versus silver, cattle versus hogs, whatever. Live streaming charts are outstanding. Full technicals, any time period you want. We also have trading recommendations, scanner trades, fundamental research as well on a 2-week trial. So I hope you found this beneficial, and thank you very much.